Hi, I'm Pattu from FreeFinCal, and many investors believe that the alpha of a fund or a stock means that it represents the excess return of the fund or the stock above the market or the benchmark index. That is not true. Alpha that's calculated for a fund or a stock or a portfolio does not equal to its excess return. It is actually excess return on a risk-adjusted basis. We're going to find out in this video what that actually means and what is that risk-adjusted basis. So if you take the equity funds from value research and plot the alpha in the vertical axis and the 3-year return in the horizontal axis, you get a graph like that. So if you look at it at that resolution, it kind of says, so why are you talking about all this? See, the return is increasing on the x-axis and the alpha is increasing. So it means that alpha represents higher the alpha, higher the return, is it not? Higher the excess return, is it not? No, that's not true at all. If you actually zoom in, you can see that, look at this region here, the return is increasing here, but the alpha is falling down. So clearly it cannot mean alpha is excess return, isn't it? Because the return is increasing, but the alpha is falling down. How is that possible? And again, you can see in this small window here, funds here, more or less having the same return, but a huge increase in alpha from almost -1 to +1. That's an alpha of 2%. So same return, you can have the huge change in alpha. Again, that tells you that alpha does not mean excess return because alpha is changing for the same return. One more example from the same data set. The 3-year return is more or less the same, 13.2% and 13.5%, but the alpha is increased by 1%. So all these means that alpha cannot be something as simple as just excess return. That is, excess return means fund has got a return of 10% and index has got 8%, so excess return is 2%. You can't say that 2% is alpha. That's not true at all. So let's look at this with some examples. So alpha is excess return calculated on a risk-adjusted basis. Now all these numbers like alpha, beta, Sharpe, Sortino, they all have problems because they're all approximations. They assume that the mutual fund returns fall on a bell curve. And that's not true at all, and that's the reason why I moved away from them and started talking about downside protection, upside capture, and rolling returns, because those do not depend on the bell curve or the normal distribution. So in order to calculate alpha, we need to define rather something called the risk-free rate or the risk-free return. So the standard choice is the fixed deposit. For value research, for its own star ratings and for its all these alpha, beta, Sortino calculations, it uses the State Bank of India's 45 to 150 day term deposit rate. Now let's take a look at some hypothetical examples. Now this is the risk-free return shown here, 6%. Fund return is 10%. Index return, which is red, is 8%. Now I can define my fund's outperformance over the risk-free return as 10% minus 6% is 4%. The benchmark's outperformance over the risk-free return as 8% minus 6%, which is 2%. Then I say the actual outperformance of the fund over the risk-free return is this 4% minus this 2%, which gives me 2%. You can pause the video to understand the wordings. You can ask me, why should I do that? I can simply take 10% minus 8% is 2%, is it not? Yes, you can do that and define that as my alpha. You can do that, but suppose you have two situations like this. Fund 10%, index 8%, risk-free return 6%. Again 10%, 8%, 6%. But notice that the fund is much more volatile than the index here than this. And in this case, the fund is less volatile than the index. So, if I want to calculate alpha or excess performance, I should say, I must penalize this fund for being more volatile than the index and I must reward this fund for being less volatile than the index. That is what the alpha does. So, in order to calculate alpha, we need to find out the relative volatility between the fund with respect to the index or the benchmark. That's called the beta. I will talk about how the beta is calculated if you are interested in a separate video. So I'll just use the numbers here for example. If beta is less than 1 or 0.8, it means that the fund has displayed only 80% of the benchmark's volatility, or it is 20% less volatile. If the beta is 1, then the fund is as volatile as the benchmark. If the beta is 1.2, then the fund is 20% more volatile than the benchmark. The standard deviation which I use in my fund reviews, it's a standard deviation is a measure of absolute risk, whereas beta is a measure of relative risk. So again, let's go back to this and let us say that the beta of this fund is 0.8 because the fund is less volatile than the index. So now I define my alpha as fund return minus risk-free return, 10% minus 6%, minus index return minus risk-free return, 8% minus 6%, multiplied by the beta. So if the beta is less than 1, then this negative factor will be less. If the beta is greater than 1, the negative factor will be more. Since the beta is less than 1, the alpha now is 2.4%, which is greater than 2%, because we are avoiding the fund because it's less volatile. So if you have multiplied it by less than 1, which is 0.8, which is the beta, so its alpha is higher than the 2%, which we calculated earlier without the beta. For the more volatile case, the beta is 1.2, let's say. Now I calculate alpha as fund return minus risk-free return, which is 10% minus 6%, minus 8% minus 6%, multiplied by a higher factor, which is 1.2. Because of that, you remove more, you penalize the fund for being more volatile, and therefore the alpha is less than 2%, which is 1.6%. Sometimes alpha can also be negative, because if the beta is so high, then this factor can be greater than that factor and it will become negative. So alpha can be negative. So that's what it means. Alpha is not excess return. Alpha is excess return on a risk adjusted basis, and we are adjusting the risk by multiplying the second term by the relative volatility of the fund with the benchmark, which is the beta. So let me end this video with a quiz. Excuse me. So I have a case here with beta is 0.8. The risk-free return is 6%. The index return is 8%. The fund return is 8%. What is the alpha here? Please leave the answer as a comment. You can calculate it, or you can just tell me whether it is 0. Is the alpha 0? Is the alpha positive? Or is the alpha negative? And what does this result tell you? So that's a 5-mark question. So I'll catch you in another video. If you have more questions on this, please let me know. See you again later. Bye-bye.